Ladies and gentlemen, welcome back to Talking Numbers, our special edition of Talking Numbers, our Property Plus series. And for those of you that don't know who I am, my name is Paul Jansz, and we're having some fun as we talk numbers and we talk about property in particular. And I know at the start of this series, I spoke about the importance of what I've been doing with my three boys and getting them into the mindset of property. We play a lot of Monopoly. It's something that I grew up playing a lot of Monopoly with my dad, and I'm pumped that I can also just, bring that little bit of joy to my three boys, and they love it. And I suppose the purpose of this series, which is brought to you by Virtual Financial and J. Anderson Property, is to try and educate you and educate all of you that are listening, and ideally family members, husbands, wives, children, to all the different key areas that we're going to be talking about. And we've started on some really cool things around some of the mistakes that property investors make, or why people invest, or why our great Australian dream is to own a property. Then we sort of went into what is rent vesting and the ability to rent somewhere you want to live, but buy and have your investments work for you somewhere else. So again, they were the first couple of episodes that we ran under this new Talking Numbers property series. So you got the ability to go back. That's the fantastic thing about this. Over the next 30 minutes or so we'll continue to share and chat about property, why it could be a great opportunity for you to look at that, from first time investing to reinvesting, to then building a portfolio. And we're going to talk about all with regards to income producing assets. Today, we're going to talk about and have some fun chatting about the housing market update. So I've got J. Anderson here from J. Anderson Property. Welcome back, mate. How are you?
Yeah, really well. And your comment about Monopoly, I've got a funny story for you. I've had a client tell me recently that he thinks my property investment journey has been modelled around the game of Monopoly, because we, in my own portfolio, we obviously first bought the first property, bought another property, bought another property, bought another property, and then with my family, we've now bought a few motels. So if you call a motel a hotel, it's very much like the game of Monopoly. So I had a client tell me, he made a joke saying that he thinks my strategy's been based on the game of Monopoly.
Love it. And look, to be honest with you, one of the things that I love doing it with my dad, apart from just playing, and obviously Monopoly, you play for hours and hours and hours, and my three boys, playing with my three boys who are 12, 10 and 6, my 6-year-old kicks my butt, and the fact that he understands, and like my 10-year-old and my 6-year-old now fight over who's going to get Mayfair and Park Lane, or it's changed now depending on probably the two expensive properties, but they know that yes, their houses are going to cost them a lot of money, but the rent, someone lands on it, they're going to get smashed, and more than likely they may bankrupt them. And as a 6-year-old, he understands that. So, that's the pleasure I take out of that, in terms of as a dad, just continually trying to educate them on something that we love, and that is where we live and where we rent and where we can buy, which is property.
Love it.
Yeah. So, mate, let's talk about today as we get into housing market around Australia. So tell us, give us a bit of a guide to what is happening, what are we in? July 2022, interesting times. Interest rates rising.
Lots of media about.
It's 100% where it's heading.
Yeah, very, very interesting times. So certainly shifting sands. I guess generally speaking, housing markets across Australia have lost a lot of their steam from where they were at. Sydney, Melbourne, and the latest data that's come out for the month of June, Sydney, Melbourne, Hobart saw a decline in their month-on-month housing values. Sydney has now seen dwelling values drop for the 5th consecutive month. Remaining capital cities, Brisbane, Adelaide, Perth, Canberra, Darwin, have seen increased values over June, although at a slower pace to their peaks earlier in the year. Regional Australia has continued to see stronger growth conditions than our combined capital cities, which is interesting. Days on market, vendor discounting are increasing, which is certainly a sign that maybe more supply is coming in and buyers are a little bit more cautious. And auction clearance rates are sitting sitting below the average level. So certainly an interesting time. The question that's probably going to come next is, what's causing this? What are the drivers behind this change? Rising interest rates and inflation is certainly impacting household spending, so that's playing a big part. Increased stock levels, so the number of properties coming on the market for sale, which is then certainly increasing supply. So we've got the supply increasing, but then demand is reducing with reduced buyer confidence, the interest rates, inflation. So we've got a change very much polar to where it was, let's say, 18 months ago, where we had huge demand and very little supply. So certainly changing. Why, I guess, I find this a fascinating time is when we have a look at human behavior, that in terms of, now is it a good time to be buying a property? 12 months ago, or even 6 months ago, when properties were selling for way above reserve, or vendors' expectations are at this level and buyers are coming in way above what the vendor was hoping to get. There's 50, 60 groups at an open home, and just prices are going nuts, and people are paying big dollars. Human behavior and human psychology, a lot of people think that was a good time to be buying a property. When you've actually got the buyers have got the power of negotiation, vendors are up here, buyers are down here, and we've actually got the power to negotiate on a property and take our time, and properties are being passed in, and we've got a lot more choice of properties, and we're not fighting against 50, 60 other groups. I'd much rather be buying in the current market. And I guess to put, to put my hand up and back that up is we're actually looking at buying a new family home at the moment, because I'm seeing this as a good opportunity, especially when you've got a longer term view. I think it's certainly an interesting time. But then in saying that, some of the regional markets we're investing in and other capital cities, it's still going, strength from strength. But a lot of the media like to focus on our core capital cities, being Sydney and Melbourne, and what's happening there. But there are thousands of different markets around Australia, so it's important to look at each of them individually.
Absolutely, and I think that's probably where, again, you sort of mentioned media just then. I think we can. It's an interesting one, because the media look to put scare tactics into everybody. That's probably what they do. They don't like to report on positives. They like to report on negatives. The old scenario of positivity doesn't sell newspapers. But it's an interesting one. Whether there's obviously the unknown. There's talk of recession. There's talk of what's happening in the US. There's the long term. I think a lot of people also tend to sort of, panic. Is that something that you've seen or can talk about in terms of what not to do, in terms of panicking around 18 months ago, you mentioned just before, to today, and how different that looks and how the next 6 months could look? What's your thoughts on that?
Yeah, certainly not. Don't panic. And I guess it's important to have that long-term view on property. You're not buying a property with the view of selling it in 6 months' time. It's a long-term play. Be conservative with your numbers. So let's say some of the modeling we do with our investors is we don't look at 52 weeks rent a year. Depending on the area, we might only calculate 48 weeks rent a year, just to build in a bit of buffer.
Yes.
Make quite big allowances for repairs, maintenance, holding costs, just because the air conditioning or the hot water system might go. We want to factor in all these possibilities. Also, up until probably 2 years ago, we were basing our long-term interest rates at 7.25%. We've then now revised that down to 6.5%. So when we're doing modeling and forecasting, we're building in buffers in terms of rental income and interest rates and stuff like that. So when you're buying a property, it's important to look at it like that, rather than going, oh, well, a year ago I got an interest rate at 2.2% and basing your numbers on those, because we know record low interest rates, it was never going to stay like that forever. So it's important just having a look at a bit more of a conservative view when you're looking at and crunching your numbers.
It's a very, very good point. And mate, let's talk about residential as opposed to, obviously we've got industrial and we've got commercial out there as well, but we'll touch on that as into future episodes of Talking Numbers. Apartments and houses are probably the main two, and you sort of look at, you only got to look at the different cities, I suppose, with the amount of high rises that continue to go up. I still get shocked by looking at we've got the ability over Melbourne to drive over the Balti Bridge, and you look at all the different cranes that are taking place in the city. You go, yep, that's another high rise coming up. What's your thoughts on apartments as opposed to houses?
It really depends on the location. So if we have a look at, say, Sydney as example, my view on apartments is pre-1970, no gym, no pool, no lift, and no more than 4 stories.
Okay.
Something like that, I'm okay
Yes.
with. Once we go to the high rise, the gym, the concierge, the 200 apartments, there's no scarcity factor in there. There's nothing that's going to trigger any real emotional connection with the property, because if there's a big apartment tower and there's 200 apartments in there and you're wanting to buy a 2-bedroom apartment, all the 2-bedroom apartments pretty much look the same in a new building like that. If I'm selling my 2-bedroom apartment and you miss out on it, well, there's probably a couple others that are already for sale in the same building, or if not, it's not going to take long. So you're not going to be caught up in emotionally and paying top dollar for it, as opposed to, that kind of pre-1970, maybe Art Deco. They're well located, they're built well, they've got a bit of character and uniqueness about them. So it really depends on the individual location and what the demographics who are living there, what do they want to buy? Where do they want to live? And then things like walkability to amenities. So if you get an apartment that's close to the city, there's a good chance, if you have a look at some of the demographics in some of these areas, like Newtown in Sydney, as an example, it's something like 53% of households do not own a registered motor vehicle. So the importance of, being close proximity, walking distance to Coles, Woolies, the train, the bus, cafes, all the rest of it is really, really important. And that's where buying, I guess, the right apartment in the right location, aligned with the demographics that are living there or wanting to live there, is okay. But if you're going to go buy high rise, off the plan, apartment where there's, 5,000 new apartments being built in that same area in the next few years, that's red flags. So it's really, really specific on the individual location, budget, and I guess strategy, whether it's an apartment or house. So there's no real clear answer, one or the other. Sorry.
Yeah, no, but fantastic. Just what you just shared then in terms of because what triggers me, I suppose, to think about there's so many different types of apartments. So you're so right. The low rise that you spoke about, 4 levels, without the pools, without the lifts, without all of that, and without the bells and whistles, because the bells and whistles also, to me, also triggers high cost in terms of body corporate. The maintenance of all of that. Yeah, it sounds great, but just you gotta look at that element of it as well, don't you?
Yeah, definitely.
Brilliant. So let's talk about maybe we might go into these I might do a little hot and not with you in terms of just how we sort of break this down moving forward. So look, a lot of people, I actually spoke to a good mate of mine only last week who said, PJ, this is what we're looking for. Do you know anyone that can help? Gold Coast, 2 better, beach views up to $1 million. Goodbye, hot or not?
So everything you've just said sounds like it's been driven by emotion. Gold Coast, beach views. Just when you said that, I was thinking, up there with the family, walking down for coffee, going to the swim in the morning, all emotion stuff. That's not a decision being made on research and data. Not saying Gold Coast is good or bad, but I'm just saying that everything that was in that question sounded more emotionally driven rather than facts, data, research.
Brilliant.
In terms of up to $1 million, if I was investing $1 million, would I be buying a 2-bedroom apartment with beach views on the Gold Coast? Definitely not. I think there's much better markets around Australia where you could be investing that money, which is going to give you much better returns and be a better investment over a long term. Big problem that Gold Coast has got with apartments is supply. As you know, you drive through there, you see how many apartment buildings there are, how many apartment complexes, and how many new ones are being built. Yes. Supply is our enemy.
So interesting. Supply is enemy. I'm just writing this down. And I think you're right in terms of that. And this is the great part about listening to these. Again, we spoke about this is an educational series. So what we're trying to bring to all of you that are listening to this is, if that comes into your mind, and it's a funny thing, I wanted to tell my good friend that spoke to me about that, is that an emotional decision? To ask yourself that, to reflect on that. And it's okay to maybe even run through the thought process of Gold Coast to better, beach views up to $1 million, because that's what's the text message. Spot on the money. That's what it was. And but then I think it's important to reflect on that and say, is this an emotional decision? Because you're right. Everything that what you said there was spot on the money. As I started to say that, you're going emotional, red flag, red flag, red flag. So yeah. I think it's important to ask yourself that, or even ask your partner that, and say, are we basing this on an emotional decision, or is it going to be the right investment decision?
And what's interesting about that as well is I think sometimes we're pressured somewhat on perception from friends and family and acquaintances as well, in that it's much cooler to say that I've got a 2-bedroom apartment with beach views in the Gold Coast than it is to say I own a 3-bed, 1-bath brick home built in the 80s in a low socioeconomic area that I wouldn't want to live in. It's much sexier and cooler to say that I've got the beach views on the Gold Coast. But
yes,
what I would rather is go in 10 years' time of saying, well, yeah, these properties that I bought from research data and investment focus have returned me X amount, so I can live the lifestyle I want, or buy the property, my dream home, as opposed to buying something that sounds good to when you're telling friends.
And you know what? That there's two things that we can have a quick talk about here, which is fantastic. And that is the first thing that sprang to my mind is in episode 1. So bring it back down to just simplistic. I'm a bit of a keep it simple fan. Keep it simple, stupid. The KISS theory. And you spoke about the why. You spoke about the strategy plan, and we've touched on it again in this episode and even in the last episode. So what's the why? So you start to question that, and the other key thing that I just wrote down then is, are you looking to, one, keep up with the Joneses, as they say? So then is it ego driven? And they're the key things you sometimes need to check yourself on. What's your thoughts on that?
Yeah, it's a question I sometimes ask clients that are kind of, juggling between, what they want to do. Is I sit down with them and say, this purchase, is it investment based or is it emotional based? Which one is it? Are you buying something because you want to have it as a holiday home, or you want it to have it as, a family home? If that's the case, it's an emotional decision. That's fine, but let's take that view, take that approach. If you're buying something for an investment reason, we need to put all that emotion stuff to the side and just look at it purely from the eyes of an investor, which comes down to that understanding the why. Yeah, why are we buying that property?
And that's probably where, again, look, and we are going to go into this in future episodes in terms of the value in using a buyer's agent and I suppose I'll call it the block. I suppose the block's been on for probably 10 years. And, I suppose that was maybe a lot of people got exposed to what a buyer's agent is. And we're going to touch on that in a couple of more episodes' time, and what is a buyer's agent, what's the value of it. But that's one of the great things that having a best mate of mine, not you, Jay, but a good mate of mine, one of my best mates is also a buyer's agent who bought my first property. It takes out that emotional. Yeah. It takes out the ability to go to that auction and maybe go the extra 10 or the extra 20 or the extra 50 because, you're getting the elbow in the rib state. We need this house. Yeah. It takes all that away because you're just making a decision based on what strategy and financial based on affordability.
Yep, spot on.
So let's talk about what's hot right now. What do you think's hot right now, mate?
Yeah, my view around, I guess, what's hot has always been, and it's what our core focus has always been, not only in my own portfolio, but for clients, is established properties, established suburbs in undersupplied areas with growing demand. So undersupplied as in percentage of stock on market of houses for sale, new development approvals, it's all low. So it's a tightly held, low supply market where we've got an increase in population growth and growing demand in that area. That in itself, where regardless of what the product or industry is, where you've got low supply, high demand, is going to translate into price growth. The other thing I really like is trying to find properties with an X factor or value add upside. So it might be, future development potential, future renovation for profit, something we can do to the property to increase the value. So we're not just reliant on the market going up in value. We can actually get a little bit active and do something to the property. A good example of something that we've been doing quite a bit recently is, imagine like the early 90s homes where you used to have the formal dining room off the kitchen. So yes. Typically you got a living room, you got a lounge room, and then you've got this formal dining room with a table there that you might use once a year at Christmas time, or it just sits there and mum's sewing machines on it and stuff like that. Never really gets used. Yeah. A lot of the times the floor plan will allow, and the size of that formal dining room is you can turn it into a bedroom. So you might be able to turn a 3-bed, 2-bath home into a 4-bed, 2-bath home. The cost of putting up some gyprock walls and a door is minimal. But just by adding another bedroom, depending on the market, you can increase the value of the property by $50,000 to $100,000 just by a very simple, small cost. You can also increase the rent on it as well. So little kind of value add, X factor stuff like that is what I really like.
Brilliant. Yeah, look, I love that. Just again, that knowledge of this is all about learning. Even me at my age and the ability, what I've gone through, I'm still picking up things today that you're saying that goes, yes, because you know why? It makes sense.
Yeah.
And that's the critical factor here. So again, if you're going through this, and whether you're looking to a new home or a new investment or kids, and I think that's one of the great things we do nowadays. We look to educate our children, and a lot of people talk about, well, how are our kids going to enter the market? That's a question we sometimes ask ourselves, especially if they are in their late teens to early 20s, as opposed to mine a little bit younger. But it's like, how are they? What's the opportunity they're going to get? So these sort of little tips and sharing of knowledge, I suppose, is probably the best way to put it, is so invaluable. So hopefully all of you that are taking this on board and can use it into the future. So what's a not for you, mate? Just to quickly touch on again. I know you touched on a couple of those before.
Off the plan. Anything off the plan.
Okay, yes. Anything off the plan.
House and land packages. It's scary stuff. Any of those new greenfield estates, anything with a glossy brochure, a pop-up stand in a local supermarket, local shopping center, any of that stuff just scares me. I've seen some horror stories of what people have bought and the prices they've paid, and shocking returns they've had. Any of that stuff is just big red flag for me.
So why not house and land? When you talk about that, to just take me through that, because people will probably, if they're starting out, young couple, house and land, yeah, great, pay $300,000, get a house and land package.
Yeah. So I guess a couple of things. Number one is going to be the supply side. So typically these house and land packages that get spruiked are in greenfield estates. So what we mean by that is it was farmland that has been converted into a housing estate, and the problem with that is we're going to have new supply, and a lot of new supply coming into that market, rather than being that tightly held low supply market that we spoke about and high demand. A lot of these greenfield estates have got high supply and low demand, which is going to impact price growth. The other thing is, and it'll probably upset a few people saying this, but we get contacted all the time by developers trying to flog these house and land packages. Some of these commissions and kickbacks and stuff like that happens in that space is just scary and disgusting, where we're seeing kickbacks being offered by developers of kind of $40,000 to $80,000 if someone presents a house and land package to a client. That's being built into the price, and the client's paying for that. So a lot of the times these house and land packages are actually, costing, whilst they might sound great value, they don't stack up. Data research behind the location doesn't make sense. The price of it doesn't make sense. And anything that needs to be sold in a glossy brochure is just a red flag for me. So we don't do any of that. 100% of what we do is established homes, established suburbs.
Yeah, and I think the key there that I took out was that you're right, 100%. When you look at those mass-produced, it's usually on land that's been rezoned to residential, and therefore your house is one of 500.
Yeah,
and therefore the supply element, you just said, when you go back to a comment before of low supply, high demand, well, there isn't low supply. There's 100 of it. So where is the growth going to come from?
Yeah, and we've got to think about what part of a property actually goes up in value. It's the land. The land goes up in value, right? So if you're buying an off the plan or house and land, you're paying a premium for the building itself, which is what depreciates, what actually goes down in value over time. Hence why you get the depreciation benefits and stuff like that. I want to spend more of my money on the land component, because that's the component that's going up in value, rather than spending it more on the house and then I get to claim the tax deductions. Well, you can claim the tax deduction, the depreciation, because it's depreciating in value.
Yes.
Which a lot of people don't get the concept of. So
no, that's right. And look, it's something, obviously, with Hugh being a very good friend of mine, it's something that's always been drilled into me in terms of land value. What's your footprint? What's your that's what's going to increase in value. You can buy the worst house in the best street. I can remember him telling me this all the time. So it's all coming back to me now. But the worst house in the best street, you know why? Because you can always knock down the worst house, but your
never
land
change
value,
the location.
Correct.
Yep.
So again, great little bits of information to share with everyone that's listening to this. So, mate, thanks again as we wrap up our next episode of Talking Numbers Property Plus. Tell us what's on our agenda for our next episode.
Yeah, so next episode, we're going to be talking about buying properties or looking at properties interstate. I guess why you should be open to investing in interstate, and some of the common questions we get around the general idea of investing interstate. One thing I might say just before we wrap this episode up is, when we're talking about what's been happening around property markets around Australia and whatnot, there's a report that came out recently which had a look at 150 cities worldwide and how they've performed over the last 12 months. Brisbane ranked number 10 on the global residential price growth over the last year, and we had 3 Australian capital cities in the top 20. So I just thought that was pretty impressive. Brisbane was number 10, Hobart number 12, and Adelaide 14. So
wow,
I can put a link to that in our show notes. If anyone's interested in having a look at that.
100%. Yeah, brilliant. And again, this is the sort of stuff that I suppose yourself at the company has got access to, and this is the data that we want to continually share with you guys. So yes, there will be all sorts of different little notes and links to all sorts of different things that you can continually educate yourself on. And hopefully this has been, again, another wonderful episode of Talking Numbers Property, where you can just continually learn about what's important and get the information and develop that plan and be really clear on how you're going to execute that. So Jay, thank you again for joining us for this episode and this new series of Talking Numbers Property Plus. It's great that you continue to share your wisdom, your knowledge, all of the information that you've taken with you through your family's journey as well. I've been in property for a number of years. So to all of you listening, thanks again. Keep an eye out for our next episode. And Jay, I'll talk to you very soon.
Looking forward to it. Cheers.
Thanks.